We're recording this right now, so very excited to start this. So again, a lot of people here from all spectrums. We got very seasoned individuals here and also people that are just getting started. And we have a chat box here. So if you have any questions, please wait for the Q&A when we do that. And then you can go ahead and post your questions, and I'll do my best to answer all of the questions. But obviously we only have an hour, and I'm gonna do my best to get to all of you. But as we are waiting on some people here, hello, David, nice to see you there. So let's go ahead and get started. So when it comes to evaluating a real estate opportunity, there's a lot of questions. John, how do we start to evaluate it? Obviously, if you are a acquisitions individual, someone that comes into a real estate deal, buying an existing asset, you're going to evaluate that a little bit different than someone looking to do a ground up. So I'm going to try to keep it very simple here and make sure that we hit on all the highlights. So let's see here. So first and foremost, how to evaluate an opportunity. So you need to analyze the local market. A lot of people, go into deals. You have some institutional people, individuals, equity firms or institutional players that they like to go to primary markets. Those are the Nashville's, Atlanta, the Dallas markets. And those markets, they will present a different matrix, different return, and also different challenges. And then you have players out there that do secondary, tertiary markets, which is actually one of the things I love to do. And since I got started in the business just about 10 and a half years ago, or just almost 11 years, that's exactly why I started. Tertiary and mid-sized markets, secondary markets, like Birmingham will be a great market, secondary market. And then there's all other sub-markets out there that within the secondary markets that really make it a nice play. At least for me, that's a great model. It's worked for me. I know there's an institutional Mid-America is a big player in the business, and they do the same. They have been doing the same, and they've done very well. So regardless of your model, whatever that is, you need to make sure that you analyze the local market. And what do I mean by that? So when you analyze the local market, you're looking at census, you're looking at population growth, MSA, what is it? What's that target MSA that you're looking for? There's a lot of when you're working with equity, there's some equities out there that will not get involved in a tertiary market or secondary market. For instance, tertiary market that is if it's less than 30,000 MSA, they're not going to play in it. So that's obviously that's their model. But also there's some institutional players that will not want to get involved unless it's 100 plus MSA. So all you need to know is what is your target and analyze that market and what you're looking for. Now, hospitals, big box players, big box stores. Those are big key things that I look for. Government, the economic development. Where's the path of progress in that market? Where's it moving? So let's take, for instance, let's take a market like Birmingham, let's say, and you're looking at centralized market. So you have, the north, the south, east, and west. So what path of growth does that market has? And also what the economic development is doing, the key players, the actual governors, mayors of the city, what are they doing? What are they pushing for? Also, you want to see what is the growth, how much, are people moving? They're moving out, job growth. What are the economic players? For instance, like I mentioned earlier, hospitals. That's a big key thing that I look for. I look for, economic drivers like, for instance, a company that's coming in and, like AT&T or Verizon, they're bringing in a bunch of people, they're moving, they're creating X amount of jobs. That's very important. Huntsville, Alabama, very, very awesome market. As a matter of fact, I want to, when I looked first into Huntsville, people were not excited about Huntsville. They're like, why are you going to Huntsville? Well, what happened in Huntsville is that we were studying markets and the market and analyzing what the future was going to look like 4 years from when I was looking, and look at it now. It has boomed. It has created a lot of job opportunities have come in, and that's what you want to focus on. It is very hard to do, but there is a lot of a lot of material that you can look for out there that I can't get into it right now that will actually help you analyze those markets and see where the path of growth is going to take place. Also, when you're looking at, obviously, job growth, you're looking at the, income capita, per capita, like what is it that that family in that area is doing to, how much money they're making, looking at housing in that market. If you go into a market and you, let's say when you're developing a deal, that market, needs to have all the components that you're looking for, but also when you in that vicinity of that investment, what are the local homes going for? Also that, what's the crime in that area? So a lot goes into the market research, and I think it's one of the best, things that you can do for yourself when you're looking at a deal, because if you go into a market that is heavily driven on one aspect of it, let's say just oil or just one derivative or actual component, that is going to be a very tricky play because you got to depend on others. So schools is another one. Big school. I'm actually looking for AAA schools and high entries to higher barriers to entry. So again, does the government, I bought a deal in a market, a tertiary market. The government doesn't like apartments in there. The municipality really does not like them. So I bought the one deal that stands in that market and decided to keep that deal. And that deal is not going anywhere because they're not going to develop any more apartments around there. The market is literally, there's a high barrier to entry. So now I'm the only apartment complex in that actual small market that can supply, a residential living for others. So key things to be mindful of. Also, Proforma, when you're modeling your the deal, what is it that you're using? There's a lot of, you can have your own models. There's companies out there that you can hire, and they can obviously provide a nice modeling, Excel format for you that you can give them all the data. You can give them your rent rolls, your T12, your trailing 12s, and they'll model something for you and obviously provide you with this nice data. Again, it is different when you're looking at an acquisition or development model. So since we do both, we have two separate models for those. And the next thing is when evaluating this on a big scale, financing. What type of financing you're gonna put in play? Yeah, big question these days. Feds are raising rates unforeseen, and that's changing the dynamics of a lot of these deals, right? So you gotta come in with that special tool, that special financing put in play that is going to help you get to your yield, get to your actual return that you're looking for, whether it's financing through Freddie, Fannie, or HUD, whatever that is. So you got to really think about exactly what financing is going to take place. It's going to take place on that investment that you're making, and of course, due diligence. Due diligence involves a lot of dynamics, and I'm going to talk further as we go into the call here. But due diligence involves going after the details. Just make sure you guys mute your phones, please, as we are discussing. There's a lot of people in this call. Make sure that when you do that due diligence, you are following, if it's an acquisition, for example, you are doing, I like to do 100% of unit walks. I like to do 100% of lease audits. I like to do, bank audits. You name it. There's a lot of things you need to follow through. There's a nice big checklist that we have that we go through it. And this checklist year after year has developed and grown more and more and more. But it is one of those most important things that you do, because this is your job. This is the time that you find out the true identity of that asset that you're looking to buy, especially on an acquisition. Now, development is completely different. Your due diligence is completely different. Some things are similar, but when it comes to building a ground up deal, your due diligence will be different. It will be, in terms of what is the pipeline out there of new deals coming in the market? What's the city? What are the ordinance? All of these requirements, you want to make sure that you have all of these, impounding fees, and wherever every city is different. So there's some challenges that you need to make sure you are aware before you start, getting into that market. So let's dive into the analysis of the local market. So as I mentioned, schools, surrounding areas, is very important. So I like to use, I'm going to give you some websites that I like to use here. Greatschools.com. It's a great website. Why? It shows you exactly what those schools are, their rate, and how they differ from other schools and graduation, standards, math, English. So it rates the school on a level. Now, when I'm going to a city, I like to see that really good rating, because that indicates, for an acquisition or development, that hey, this is going to be a good asset to position in this school district, because students are going to be coming to this school, to living in this apartment and going to the school. So you want to add that amenity to your asset. So you want to make sure that you have great schools around it if you can help it. Surrounding areas, the Google Maps. This is something that we use quite a bit. And what do I mean by that? A lot of times you're looking at deals, and one of the things that I like to do is I like to drive Google Maps. This is such a great tool. I take the little man there and drop them in the actual map and start driving. I'm looking for key things, especially in a market that I don't know. So I like to drive by gas stations. I like to drive by, market areas and places near the vicinity or in the area of the actual asset. I'm looking for things like, what does it look like? Places of business. Do gas stations have bars? Believe me, this is something I look for, because it just tells you a little bit more about the property, and especially when you go into the next one that I'm going to talk about. Spotcrime.com is one that I like to use. We use others, but this is another one that I like to use. So when I'm driving Google Maps, I'm also looking at spotcrime.com and seeing where these things are happening, and drive that area and see what it looks like before I even execute my deal. So that is very important, because this is, you don't want to go into an area that is going to be challenging. That's the last thing you want to do. Property values, Zillow.com, as I mentioned earlier too. Zillow.com is very, very cool tool. And there's others out there, but Zillow.com, we have taken, for instance, there was a deal that we were going to do in Texas, ground up development. And, it was presented to us as a great deal. All deals are great. Okay, everyone, if you're a broker, please call me later. But I'm just telling you, every time, here's your job to find out if the deal is great. So this deal was planted in a decent vicinity, but then we started doing the Zillow.com all around it and found out that, hey, these rents were $1,200 a unit, okay? But the homes in the area were 150, 117, and we sold one at 89,000. And quite frankly, that starts creating a different set of dynamics for you and your assets, especially when your rents are like, double the amount. So that right there is not a good thing to do, or not a good place to be, at least for me. I like to look at those. So Spotcrime, Google Maps, drive it around. Zillow, the same thing. I like to look at those properties. I want to see what the area looks like. So utilize that tool. Citydata.com, economic drivers, excellent website as well. And I'm sure there's a lot of people here that can post and say, hey, I use XYZ, which will also help you. But also rents. We are in the business of collecting rents and making that passive income, creating that cash flow. People say cash is king. Yes, cash flow is king for me. So I want to make sure that I'm going to be cash flowing this deal. So apartments.com, rents.com. There's a lot of different, you can also go on Zillow, they have some rents in there too. So, but apartments.com is a good tool to use for rents. And if you want to get deeper into the system, pay for something out there, you got, Yardi Matrix, you can use Yardi Matrix, you can use Red IQ. Now I'm talking to those guys that are veterans here that know exactly what they're, they know a lot of this, but we all use the same tools. CoStar is another one that we like to use. So bottom line is there's so many different tools, but you just got to find one that makes sense to you, that is cost effective. Also, demographics, census.gov. I mean, I like to look at those, and see what's going on. I'm gonna throw one out there. U-Haul migration is a big one. Hey, look where everybody's moving. Where they're moving to, where they're moving from. because at the end, people need to live where you want to build or buy. And if people are moving out, not a good thing. So for instance, yesterday when I was looking at the whole United States, the hottest states with a lot of green, which means people are moving in, where you guessed it, Texas and Florida. And Alabama was up there, but a lot of the southern states, but Texas and Florida were so glowing green that it was amazing. Now, a lot of the states that are moving out of, you name it, New York, Chicago, all these different cities, people are just migrating south, and also from out west, from California down to the valleys of New Mexico and Nevada and all that. So a lot of this is good tools to actually look and see into the future, and hopefully make a wise decision on all of that. So key things to watch when you're evaluating a deal. Now let's talk about Proforma. This is a simple Proforma. This is something that we just put together, but utilize market rates, comps, when projecting revenue and expenses. So let me talk a little bit about this for those that are already, in the game and they know a lot. This is gonna sound redundant, but to those that are getting into it, you want to look at your cash flow projections. You want to take your revenues, your expenses, and then you're looking at that magic number, NOI. That's what we're looking for. We want to increase that NOI. We buy deals based on NOI, cap rates, especially when you're buying an acquisition. We build deals based on return on cost. What is that number is going to be? And we're looking for a healthy number. I mean, 6 plus 7. I mean, that's a healthy number. If you're doing a deal and actually has that, a 7, or it's almost a 7 in the front, I mean, it's excellent when it comes to an evaluation on development. But let's talk about acquisitions. So economic drivers. Obviously here we're looking at the T12 and the T3 income, and the T12 expenses. That's what the lender's looking at. So that's what we like to focus. So T3 income, T12 expenses. I don't advise looking at a T1 income, situation and saying, hey, I'm going to buy it based on a T1. That is the trailing one. We like to look at the trailing 3 months and see what that property is doing. It's a good indicative of where it's going in essence. It may not give you the whole picture, but it gives you a pretty good picture. But you want to take your, economic occupancy, physical occupancy, market rents, loss to lease, vacancies, concessions, and you have to take everything that is current, then you model it accordingly to what you think that will be. I like to be conservative. When we do our analysis, we're looking at a market, if the market is doing, let's say the market vacancy is 5%, or in other words, everything is 95% occupied. I'm not going to underwrite to a 95% occupancy. Okay, so I'm going to underwrite to a 92% occupancy. I'm going to underwrite it a little bit lower. Also, sometimes when I take over a property, you will see this little dip at the beginning on occupancy if I need to evacuate or pull people out that obviously that I'm not going to be renewing. But for the most part, we like to buy deals that are already somewhat established, and that transition makes it a little bit better. So that being said, keep your your occupancies when you're underwriting these at a very nominal level, if you will. And your rent increases, you gotta, especially now, you gotta watch out for those. Those can be, I've seen some crazy rent increases out there. Obviously, you follow data to make those, those calls. But I will not go into these 10, 12% rent increases and put in X amount of dollars and expect these huge returns, especially in an acquisition. You can get in trouble with that. You got to be careful. Now, if you're doing a ground up development, it's different. I mean, when you're doing the lease up, you're actually having people coming in and you're bringing in these new leases. Well, you can take a piece of, let's say you got another 30 units to lease that month. Well, let's go ahead and raise the rents a little bit and see what it does. And if you are getting them, great. So that's something very typical that we see on deals. Like right now, we're going through two properties that we're getting certificates of occupancies right now. And every time we seen this, we elevated the rents, we're getting it. So we're going to continue that trend until we don't get them anymore. But lease up is very important. And also you got to be very cautious on how you do it. You got to have the right management team as well in place, because if you don't, I mean, it can hurt you. It can put you behind. Now, let's talk about expenses really briefly here. T12 expenses, those are the trailing 12 expenses. You want to watch those, utilities. You want to watch the insurance. You should those controllable and uncontrollable expenses. Those controllable expenses, obviously, those are things that you can actually control yourself. But uncontrollables like taxes, insurance, these are big numbers, and you have to underwrite, to those numbers. Now, myself, I don't like to depend on my team internally to come up with a property tax number or insurance number. We always like to go and hire a third party to help us with that, and that's all they do. And they analyze the taxes for us, and they give us a future expectation on this tax number. And they're great companies out there that are that do this. And obviously, we use the same company for the last 10 years as I got in the business, and they've been great. So they give us a number, and we go with that number, unless they tell us you can back down, or if we contest this, it would drop. So follow what they tell you, stick to them. And there's several companies out there that I can also recommend. But obviously, the one that we use is the one that I recommend, because that's it. And it's they're out of Atlanta, Fellows Insurance. I'll tell you, they're awesome guys. So insurance, again, find a group that you feel comfortable with. There's so many of them out there, but please be careful on how you insure. Make sure you're not underinsured. And this has changed so much, especially in the coast. Their deals, if you're building a deal right now, or if you're buying a deal, you're going to face some challenges on these insurance, numbers, because I mean, yesterday I heard an insurance per unit on a deal in the coast of Texas. It was like $2,500 a unit. That is huge. And some of you out there may be like, wow, that's huge. And some of you out there may be like, hey, I get it. I probably got more, who knows? But bottom line is, you gotta measure against that insurance bracket, and make sure that you are doing your due diligence. You are measuring it to what they're telling you that it's going to be, and hope for the best, plan for the worst, but put that number in there and see if your deal works. But everything else, contract services, payroll and benefits. I got to talk about this here briefly. So payroll is something that we like to go into. When we go into Yardi Matrix, it's a tool that we use, that we have. I like to look at the payroll in the area. Also, Red IQ gives you some of this information too. But when you're looking at the payroll in the area, I like to see what the market is doing, because at the end of the day, I don't want to come in there and put a payroll that is going to deflate, my operations. So if anything, or what I always do is I look at that payroll and I increase it just a tad, just to be safe. And I always looking to see, when I go into a property, especially on an acquisition, who are the manager, the assistant, and obviously get to know them, because these are the people that are going to be running your asset, and you have to be careful about that, and make sure that they're going to be obviously the right people for your deal. So that being said, make sure you do that due diligence, and make sure you get that and are well aware of what the market is charging. Now, so I'm going to repeat it. Fellows Insurers is the company out of Atlanta that does all of our taxes. So that's a plug for them there. I'm sure they appreciate it. And so let's move on. Debt service cover ratio is one important thing to look at, especially in this market. You want to make sure that you're underwriting to 120s, 125. But again, a lot is changing on this. It's so dynamic right now. I mean, and listen, we are going through it, right? Especially, when you have construction deals that are on construction loans, and you're trying to put permanent financing, you can only imagine the amount of things that the tasks that you got to do here and accomplish. And also, if you are under contract on a deal right now, and you're trying to execute that deal and consummate that sale, there's a lot going on with that. So obviously, loan to cost, on a deal, let's say a new construction deal, 67% loan to cost is a great number, but I mean, deals are getting tougher to do at those numbers, and obviously, there's so many different financing, but available out there. But at the end of the day, you got to watch, you got to underwrite for that debt service cover that makes sense, and also that the lender will give you that loan. But again, a lot to cover on that, and a lot is changing there too. So I'll go ahead at the end and give the those tax guys number and name down there. I'll make sure I do that. Thanks for the questions on that. So let's move on here. Okay, return matrix. When we're looking at a return matrix, I wanted to combine a few things in here. Obviously, we do development and also acquisition. So we wanted to make sure that touch upon some of the highlights here. We can't get on into all the specifics, but we look at internal rate of return on a deal that we're buying, executing. Obviously, as you see here, is the annual rent, the rate of growth expected to generate investment that this investment is expected to generate. So we're looking at that return, internal rate of return. What is that deal going to perform in the future? Let's say we buy in this deal, we solve for a 15%, 15% internal rate of return is what we like to solve for. Some people like higher, but on a normal cases, I'm looking for a 15% return on that. Somebody please mute your phones. Cash on cash return. That's another big number that we look at. Obviously, cash flow is king for me, and I'm looking at deals that cash flow on a monthly basis, on a yearly basis. So cash on cash is make sure. I'm sorry, I'm getting some feedback. Please, if you're one of those, I can go in here and delete that. That'll be great. Mute these people here.
Thank you, Ryan.
Please mute your phones, fellas. I appreciate it. Thank you so much. Thank you so much. Okay, so going back, cash on cash. Make sure you're looking at your cash on cash. Return on cost, like I mentioned that earlier, when it comes to doing deals and developing deals. Equity multiple is another big one. We like to look at the cash on cash and equity multiple of that deal. When actually we sell it, or do a capital event. Now, a lot of people ask me, hey John, you are going, I've done both. What I mean by this is I've done, sales, buy and hold 5, 7, 3 years and sell it. And also I'm getting to now the long-term hold. Why am I saying that? I mean, it makes sense to me. I've done some deals that actually have done, executed, the management company has done well. And we come in and done recaps and also done some refis in it when the right time, right? Not a good time to do that today, but we've taken our equity out and realized a equity multiple of 1.8, 1.75 roughly, but it's tax-free because the government doesn't tax you on that. So that in itself, it's a true number, and you still hold the asset. You still have the asset producing cash flow for you and moving on into fair wins and better wins and ahead. Now, that doesn't mean that, hey, selling it's not a good thing. It's your model. It's what model you use. But when you're looking at a 2.5, 2.3 equity multiple, for example, then by the time you pay capital gains and the fees and yield maintenance, it drops that significantly. So I've been there, I've done that, and to me, it makes sense to hold an asset, cash flow it, recap it, do a supplemental refi, whatever that is, and in due time. That doesn't happen overnight. And once you get that equity back, it's in your pocket, redeployable, tax, with no tax liability, and you still own the asset. It's the best of both worlds for me. So I like that model. Now, let's move on here as we proceed here, because I want to get to Q&A. Financing, huge. This is the instrument where you will structure your deals. Obviously, there's a lot of things that we don't know in the future, and it's all a guess, right? Who knew that the Feds were going to increase rates this rapidly in such a short time? No one knew, right? But at the end of the day, you got to be able to accommodate and find out what other next steps you got to do, if anything, and also focus on the actual instrument that you're going to use for that investment on an acquisition deal. On a development deal, there's life codes, there's bridge that you can take to permanent when like I like to do the construction loan and then take HUD and obviously refinance with the construction loan with a HUD deal. So that's just me. I like that model. Some people may not like it. But you know, some people will take permanent financing, and some people do recourse all day long on complete, you know, recourse based on completion, on how much completion you, and then the recourse burns off. I like non-recourse. Call me, you know, I don't know, call me a chicken, whatever, but I like to be conservative. So recourse is definitely something that, you know, and non-recourse that we look at, but, you know, obviously it fits your model and it fits your gut, go for it. But Fannie Mae, Freddie Mac, HUD, these are the big ones, right? So there's so much product in between them, you know, fixed rates, floaters, that, you know, float to fixed loan, you know, tax, you know, tenant advantage committee, you know, Freddie and Fannie have different programs, you know, small balance loans, you name it. It is a slew of products out there that will fit your investment. And all you have to do is, you know, find what's best for you. Now, you have to have, you know, lenders out there that you can trust. There's guys out there that, you know, that I like to use, and, you know, folks that do a good job. So at the end of the day, find who you like and how, you know, make sure that they always educating you and keeping you abreast of what's going on. You know, so Lumen, Berkadia, they're great companies. So they do a lot of great business, and obviously, you know, those are the guys I would go to. Now, due diligence. I know I spoke about this earlier. Risk, documentation, inspection, okay? And also you need to find out, I know, you know, all the contacts, you know, that you're working with. Very important on this. So unpaid penalties when it comes to risk, you know, potential losses in the property, insurance loss, you know, city violations. This is where you have to mitigate your risk and see what's going on, because you take that into consideration based on what you're going to purchase or build. You know, deferred maintenance. What are the, you know, the roofs are new, whatever. You need to analyze them. Make sure that you have insurance. Make sure you have, you know, warranties if they're new. But bottom line is just check your boxes and go through your due diligence checklist. Documentations, you know, that's something that we look for. We underwrite everything. You know, you want to look at, you know, balance sheets, bank statements, invoices, delinquency reports. There's a story there. So it's up to you to find out what that story is and make sure that it makes sense to you. Inspection, unit by unit walk, inspection, physical and financial, you know, fire inspections. This is a big one. You know, a lot of cities have different you know, requirements. And when you're doing a fire inspection, you know, there's fire inspections that you want to make sure they actually have done and kept up, because believe me, it will drop a lemon on your juice, you know, because listen, I'm talking from experience. You know, after owning a property for so many years, you know, there was some issue that came up unannounced to me that I had no idea the previous developer did, and unfortunately, it was on me, and I had to take care of it. But ended up being a blessing. Just like anything out there, sometimes, you know, difficulties show up and they're really bad, but they become blessings if you, you know, do the right things. And obviously that turned out to be a great thing for us, and it's on the property today, and it's awesome. Flood inspections, you know, make sure that, especially you buying on the coast, what have you, checking the floods, maps, insurance, all of that, and make sure you are well protected. So a lot of different things that you need to do to make sure you got all the right protection, and making sure all the inspections are done. But, you know, work closer with your lender, like I said, insurance brokers, tax professionals, attorneys. These are key people in your team that will help you manage through this due diligence process and contract and hopefully to closing, and you can have a successful deal. Any questions, anyone? Now I'm open to questions. I know I spoke fast, spoke a lot, but my goal was to get it in 35 minutes, and I think we're there. And I would like to, you know, open it up for questions, because I know that may have a lot of questions here since we have a lot of people. Let's see. Let's see here. Okay, John, admin note. Can we access these slides after the? Sure. I'll send them. Just DM me, and I'll make sure you get them. Any other questions about anything when looking at evaluating a deal? Okay, the company name is Fellers and Sure. Fellers and Sure. There you go. All right, out of Atlanta. Okay, what is a good debt service ratio amount? Debt good 125 is what that's a healthy one. That's what everybody underwrites to. But obviously like to see higher. That's just me. Thanks, Frank. Thanks for the comment. Any other questions? Keep in mind, building a deal and doing an acquisition, there's different things, different models, and going from acquisitions to development is a huge, daunting step. At least it was for me. And but I believe in in strategizing and making, just being versatile, and that's what we like. That's what we've done. But it's a lot. It's not for the faint of heart, for sure. But hey, if I did it, you guys can do it too. Any other questions?
Hey, John, good morning. Luis Florentino here.
Good morning.
Yeah, I just have a quick question. But first of all, I just want to say thank you so much for doing this for us. And yeah, just quick question. By having a real estate license, does that will help you and we give you an advantage in the market?
Yeah, so my story is, if you guys have not seen that, I've been posting some stuff in videos, what have you. I got started as a realtor. I was a real estate agent. I was a former officer and pilot, and I flew for the airlines. And I got into real estate by literally desperation in 2003, and I started selling real estate. And literally, I began my career selling homes. I was a resi, what they call it, and I sold residential real estate. And market crash in 2007. I had my company, Providence Real Estate. Had 17 brokers working for me, not exactly in 2007, but when the market crashed, I was actually doing a lot of REOs and BPOs, brokerage price opinions, for two major banks back then. And when the market crashed, I got inundated with business on foreclosures in 2007. And that's how I got into the business, in a massive way. I hired 17 brokers, and I had a bunch of homes I couldn't sell. They were not mine, and I ended up turning those homes into rentals. And that's how my management company was born. And I discovered the power of residual income, mailbox money, what I call it. And that's how I got into the business of multifamily later on in 2012.
Perfect. Thank you. Thank you so much.
Mm-hmm. So another question here. Please advise how to visit with you or your team, partner, and invest in your, okay. Yeah, just DM me. We are, providenceinvestments.com. It's our company. We work with family office and, high net worth investors and institutional partners. We're very active, up to the, obviously very cautious as well too these days. But yeah, thank you. You can just DM me, PN me, and that'll be great. Send an email to, Providence IR, that's investor relations, IR at providenceinvestments.com. I'll make that right now. IR at, if you are interested. That's our email. Okay. Let's see here. All right. So another questions. What is the website of finding what states and cities people are moving to? Vanessa, great question. There's a lot of websites out there. I like to use U-Haul migration. It's one of those things, but there's more available. So there's a lot out there that you can, some, free, maybe not so exact or precise, but also if you pay for something, I'm sure you're getting some value out of it. So I suggest, do both and see what the value is. Okay, what cap rate we should consider to buy? Great question. What cap rate? That depends on what kind of returns you're looking for. Obviously, rates, let's say, how can I say this? I don't like to buy inverted. And again, it's not a blanket question, or not a blanket answer, but what I mean by that is if they're selling me a deal for a 3.5 cap and rates are at 5, I mean, that doesn't make sense to me. It doesn't make sense on the front end. I mean, it may have a huge value play on the management side or something that I totally, don't see. But I mean, but every deal is specific. That's what I love about real estate. No deal is the same. So you got to really analyze the deal and make sure that, you're hitting your matrix. So what are your matrix? I look for, I look for a decent cash on cash return. Obviously that it's not the same as it was 3 years ago. Obviously if we're looking for 10 before, it might be a 7 today, or 6.5. Again, you just got to make sure, your matrix makes sense. That's it. And be comfortable with it, really, at the end of the day. So my contact information, providenceinvestments.com. That's our website. Please visit there and you can send us an email. John M at Providence Investments is my email, or IR at providenceinvestments.com. Any other questions? Let's see. All righty. What cities are great to invest in? Couldn't tell you. I'm not gonna tell you. It's just you gotta have a model. You gotta have a model that makes sense. That what is your model, right? And like I mentioned earlier in the call, I like to invest in tertiary, secondary markets. Why? I believe there's more yield. Not believe there is more yield in those markets than a primary market. In a primary market, you finding that you competing with way too many people, institutional players, and that cap rate becomes extremely tighter and tighter and tighter, and that makes it tough to make returns work. Then again, moving out to a secondary, tertiary market is completely, you got more yield play, but you have other risk. So it's what are you looking for? So at the end of the day, it needs to you need to come up with a matrix that makes sense to you and that you feel comfortable with. And that's something that it's a business plan. That's truly what it is. Does it fit your business plan? And execute from there. Anything else? Any other questions? Okay. Great. Well, I appreciate everyone here and thank you for joining me. If you don't have any questions, again, I know I spoke fast. Just trying to get it to a point that we can have a nice little Q&A, and it's all great. But really appreciate you guys. More questions here. Always, let's see here. Okay, so the question again: secondary markets, tertiary markets, Birmingham, Alabama, Mobile, Alabama, for instance. These are markets that considered secondary markets. Tertiary markets. Lubbock, Texas. These are markets that different markets out there. Like Orlando will be a primary market, right? Atlanta. But then you have your Augusta, Georgia. So you got your Savannah, Franklin, Tennessee, in Nashville. So there's a lot of different markets like that. So, in essence, comparing it to the MSA, million less, or, 800,000, for, $500,000. These are markets that I would consider, to be secondary, but it's just the breakdown of the population growth and and obviously all of that. Let's see. Anything else? Any other questions? So again, modeling. There's a lot of models out there. What can you use to model? You can, you can hire different people to do that. There are companies out there that will do modeling for you, that you can provide them with the information, and also you can come up with your own model. And listen, when I started modeling, I had one Excel model, and I'm not a finance major. I'm an ex-pilot, guy and officer, and my Excel experience was like literally from 1 to 10, about a 2. And I just got, listen, when you have the need, you will find a way. But you don't need to do it my way. So you can actually hire some people to do this in companies, and also find, a decent Excel model that makes sense, and learn from it. But I don't think it's impossible or difficult in that sense, but you can learn it. That's what I would suggest. Great. Okay, so awesome. So no more questions. I appreciate everyone coming in, standing by. I hope you guys learned something, at least on how to, at least how to look for what you need out there to evaluate a property or an investment. And for those that are, veterans, and obviously friends of mine that do this all day in and day out, that actually I've learned from too. Thank you for coming on. And hopefully you got one or two nuggets out of it. I mean, for me, if I get one little thing out of one meeting, it's worth it. So appreciate everyone. Thank you so much, and many blessings and much success to all you guys out there. Have a good one. Thank you so much for visiting.